In this week's video, we'll review numerous charts and indicators to help us better understand the probabilities associated with the long-term outlook for stocks. To view the video in full screen mode, use this icon in the lower right-hand corner of your video player. To improve the clarity of the charts, use this icon in the lower right-hand corner of your video player. In August of 2016, in a video with this title, we covered a rare signal that had only occurred 10 other times in the past 35 years. It was a bullish signal, and in that video, we used the 30, 40, and 50-week generic and for illustrated purposes only weekly moving averages. Since we're talking about trends here, those same moving averages can help us understand what it looks like when a long-term bullish trend morphs into and flips over into a long-term bearish trend, which is exactly what happened in late 2007. In the present day, if we felt that the analysis from August of 2016 was starting to crumble, we would expect the present day chart to be taking on a look similar to this concerning look here late in calendar year 2007. If we look at the exact same moving averages in mid-July of 2017, you can see we still have a full-bore bullish look, with blue the fastest moving average on top, and the slopes of all of the moving averages are still positive. These charts do have something in common. Here's a consolidation period here, a bearish breakdown here, and then a retest of that area here, where the retest comes back and tests the bottom of the box, or the breakdown in this case. We have basically the same situation here, but it's a bullish breakout and a retest here and a successful retest. This is a successful bearish retest. And notice, as all of this is happening, our moving averages morph from a full-bore bullish look to a full-bore bearish look. Here, we morph from a full-bore bearish look into a full-bore bullish look. As we've noted in past videos, the chart in 2017, this looks more like a major bottom. It really doesn't look anything like a major top. Similar concepts here, so we'll move quickly. Here's the topping process. Low probability look in the NASDAQ in 2007 and 2008. Notice as the market started to top and the trend was waning here, the moving averages started to cluster together and price was near the moving averages. This is an indecisive look in here and here. We don't have anything like that today. This looks like a strong bullish trend on July 13th, 2017. The Dow was singing from a similar hymnal as it peaked in 2007. This is the look we want to avoid. And this is the constructive look in mid-July of 2017 using the exact same 30, 40, and 50-week moving averages. In November of 2016 on See It Market, using this title here, we did a Bollinger Band analysis. You might remember it's rare for the Bollinger Band width to get this low here. You can see in the early 80s it was low. Good things happened. Very, very low in 1995. After that, good things happened. And low again here, and after that, good things happened for a long period of time. We had a similar turn up from low levels back in November of 2016. How does that exact same chart look today? Has the bullish probabilistic look been negated? In mid-July of 2013, the answer is no. This chart is acting exactly as we would expect it to, with the Bollinger Band width rising off of low levels, rising off of low levels, rising off of low levels as the stock market rallies. Like all the charts we review in these videos, we're not predicting here. These charts help us with the probability of good things happening relative to the probability of bad things happening. If the look of the chart shifts, then we have to be flexible enough to change our assessment of the data. How about market breadth? NYSE new highs minus new lows. Are we seeing a bearish divergence? We had a bearish divergence in place for a long time before the stock market peaked in calendar year 2000 here. We also had a bearish divergence in calendar year 2007 when the S&P 500 printed a new high in October, and you can see breadth fell off the table and printed a discernible lower high. Do we have the same yellow flags waving in July of 2017? The answer is no. We have a short-term bullish divergence with the exact same breadth indicator making a new high in mid-July of 2017. The S&P 500 has not yet printed a new high as of July 13th, but this is a positive-looking setup from a probability perspective rather than these negative-looking setups from a probability perspective. In all of these examples, when we reference past videos, you can Google the title of the video and find it if you want to see the original and more detailed analysis. This is the monthly MACD chart that we covered in December of 2016. It's relatively rare to get black moving above red like this. It's only happened approximately 6 times since 1993, including the bullish cross that occurred in calendar year 2016. MACD helps us monitor long-term momentum. You can see we get consolidation here in the 90s, the bullish breakout in the S&P 500 here, and simultaneously we get somewhat of a confirmation look here with MACD. If we fast forward to the present day, is monthly MACD throwing up caution flags? And to answer that question, it's very helpful to have some historical references. This is what MACD monthly looks like when probabilities are going from favorable to unfavorable, favorable to unfavorable, calendar year 2000, 2007. This is the higher probability look that we want to embrace. We want to avoid this. This is a bullish cross, calendar year 2002 here, 2003, and calendar year 2009. Therefore, does the present day look more like the right side of the screen or we want to avoid the left side of the screen? When we compare the periods head to head, we can see in mid-July of 2017, MACD in the present day really doesn't look anything like the rollover in 2000. It doesn't look anything like the concerning look that we could see, measure, and put in a model and observe in late 2007. And it looks a lot like the favorable bullish turn or major bottom in 2002 and 2003, and it looks a lot like the turn in calendar year 2009. Is it possible that this morphs into a look like this? Absolutely, positively, yes. But the important thing is it hasn't done that yet, and we make decisions based on the evidence that we have in hand or the data in the now, rather than uncertain forecasts about an uncertain future. We can also use monthly MACD for ratios. This is the ratio of stocks risk on relative to bonds, TLT here. Here's your monthly MACD. Here's that bearish or concerning look for the ratio as long-term momentum rolls over against stocks and in favor of defensive bonds late in calendar year 2007. This is the look that we want to embrace in the same ratio. Now the odds and momentum are starting to shift in favor of owning SPY, or the S&P 500, over long-term treasury bonds, or TLT. The original analysis that we conducted was in December of 2016, and it's proved to be very helpful from a probability perspective. Back in December, we said this looks a lot more like this favorable turn and really doesn't look anything like this unfavorable turn in 2007. Has anything changed here that would start waving red flags about our big picture or weight of the evidence analysis? As of July 13th, 2017, the answer is no. Black MACD still has a very constructive look, with black starting to pull away from red again, rather than the concerning look that would see the two converge. We're about halfway through July, and so far SPY is outperforming defensive, or I'm concerned, TLT by 2.46% this month. A fair question might be, why are we reviewing all of this? We've covered this before. This quote from Market Wizards can help us frame the answer. Take a theory and stick with it. But you also have to be open-minded enough to switch tracks if you feel that your theory has been proven wrong. So when we go back and revisit these charts, we're doing it from two perspectives. Perspective number one, can we find anything on these charts that contradicts our original theory? If the answer is no, then for the most part, any volatility, as long as the math allows, should be treated. The default should be volatility to ignore, and that's why we've been holding our positions for so long. And as we review these charts, we're also reviewing them in an open-minded manner, because if we did see things that were contradicting our original theory, then it tells us when that math starts to deteriorate, then it'll be very, very easy to change our course, because it doesn't look like charts that would align with our original bullish theory. Revisiting the same charts and the same moving averages and the same indicators is very, very helpful in terms of keeping that open mind and allowing us to maintain that all-important maximum flexibility 100% of the time. Keeping all of that in mind, let's continue. In January of 2017, we published a video with the title, The Mother of All Stock Market Signals. This is January 26, 2017, NYSE Composite Weekly. You may remember we talked about the fact that price was inside of this box. This is consolidation, or an indecisive period, for 19.6 years. And market fractals tell us that a long-term consolidation is just as important as a shorter-term consolidation. So if it looks like a breakout on a 60-minute chart, and it looks like a breakout on a 20-year chart, both should be treated in the identical fashion, not similar, identical fashion from a technical perspective. And you might remember in the original analysis, the important thing was we were trying to break out of this large orange box, and in January of 2017, we had done that, and we were now trying to break out of a much shorter consolidation box. You may remember we used this quote from Market Wizards. When a market makes a historic high, over here to the right, it is telling you something. No matter how many people tell you why the market shouldn't be that high or why nothing has changed, the mere fact that price is at a new high, right side of the screen, tells you something has changed. And in this case, the mother of all stock market signals is relative to this high made here in the center of the box in calendar year 2007. Therefore, if we check in on the same chart in the present day and we're above this box here, then that means the mother of all stock market signals remains in place, because we would also be above this box here. If we look at the same chart, this is a little cutout here as of July 12th, 2017, the mother of all stock market signals remains in place. We're still above this box here, and in fact, this looks even better now. Now this looks like a bullish breakout from a shorter term multi-year consolidation box. We broke out, we came back, and we retested the breakout here, and we've gone on to make a higher high. Right now, this looks like a bullish breakout and a successful retest. Given everything we know today, the mother of all stock market signals remains in place. Why is that relevant? A very brief historical review will help us answer that question. NYSE monthly now, 1965 to 2017. This is the chart that we used in late January in this video. The longer a market goes sideways, and in the present day, it's a 19-year consolidation box that we've broken above. The longer a market goes sideways, the bigger the move that we can expect to get when we either get a bullish breakout or bearish breakdown. In 1982, we got a bullish breakout, a successful retest, and then we went on to make a higher high. You may also remember that we used the 50-month moving average to help us discern between volatility to ignore from a conceptual perspective and volatility to respect and volatility to respect. And we noted in 2016, this was a concerning look here, coming back and testing that. It failed here, and really bad things happened. It failed here, retested it, and then really bad things happened. So the question in 2016 was, will this look more like this, or will it look more like these successful retests of the 50-month moving average? And in each case after that, good things happened for a long period of time. We know the answer. In 2017, we kissed the 50-month moving average, closed below it for 1 month, and now we've gone on to move back above it. This is January of 2017. How does the same chart look today? The answer is healthy. Price remains above an upward sloping 50-month moving average, and we also have improvement. Now we've made a discernible higher high above this high and a discernible higher high above this high. After reviewing a broad brushstroke of evidence, we have nothing in hand from a factual perspective that contradicts anything that we've been talking about over the past 10 months. As long as that is the case, it's extremely important to keep our eye on our North Star, which is to properly and successfully navigate between a point A and a point B. And given the data that we have in hand, it's within the realm of reason that point B could be several years in the future. Obviously, that's to be determined. And we know even under the most bullish circumstances, there will be plenty of volatility between a point A and a point B. Plenty of volatility between a point A and a point B. Plenty of volatility between a point A and a point B. The charts, the facts, the weight of the evidence, and the model help us discern between volatility to ignore and volatility to respect. Volatility to ignore and volatility to respect. And we also know with 100% certainty, even under the most bullish circumstances and under extremely strong trending conditions, the market never makes anything easy on anyone. And since we're all human, we constantly have to battle and make sure and guard against these common missteps that are constantly trying to get us off track between point A and point B. And as we head into next week, we know it's always important to maintain that flexible, unbiased, and open mind. One thing that's extremely important, a flexible and open mind does not discount the facts that we have in hand. Our interpretation of the facts that we have in hand can be a firm interpretation. And right now, given what's in front of us, it looks like we could be at the early stages of a long-term secular bullish trend, which equates to the possibility for enormous opportunity looking out several years. We track all of this and convert it into a usable and actionable format in a reasonable amount of time. The submodels, we answer binary questions, some of them manually done, some of them programmed in Excel, and we also enter in unbiased and hard data. The submodels allow us to get a handle on the market's current profile, and the master CCM market model then looks at the current profile, compares it to past profiles, and recommends a prudent allocation between risk assets such as stocks and conservative assets such as bonds. Conservative assets can consist of cash, bonds, currencies, or any number of investment options. If you'd like to learn more about the market model or our money management services, you can visit our website, follow along on Twitter, Facebook, read our blog short takes, or watch past videos on the Shivako Capital channel on YouTube. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or offer to buy or sell any security or any related financial instruments, nor should any of the content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Shivako Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.